This is a lesson for Financial Literacy 8 for April 15th, which is Wednesday. That's on types of credit. This is part of outcome number 2, which is on credit and debt. So what is credit? Credit is the ability to borrow money and pay it back later. You notice the word ability in there. It's just that you have the ability to borrow money. That doesn't mean that you actually have to borrow anything. You can have a high credit limit, and that means a lot of people will trust you. If you do happen to borrow money, they trust you that you're going to pay it back. But you don't actually have to borrow anything to have credit. Most of the time, when you do borrow, you need to pay back more money than what you borrowed, and that's called interest. Interest is the amount of money you pay to use somebody else's money. So if I borrowed $10 from a friend and he said, oh, that's okay, you can pay me back next month, but I want $12 when you pay me back, that extra $2 is interest. And interest can also be the amount of money that you earn when you're borrowing or when you're loaning money to other people. So interest is not always a bad thing. It depends on whether you're paying the interest or whether you're earning the interest. It's generally not a good idea to pay interest if you can avoid it, because you're just paying money and then not getting any real value out of it. But it's always a good idea to earn interest whenever you can, because you're making money off of your money. Another way that you could think of it is that interest is the price of money. If you want to use somebody else's money, they have to pay you for the privilege of using your money. If you want to use somebody else's money, then you have to pay them the privilege of getting to use their money. Now, when we talk about interest, it's generally a dollar amount. The term interest is a dollar amount, but it's really tough to compare when we have different loan amounts and different amounts of interest and stuff like that. So it's hard to tell what's the better deal. So we also have a term called annual percentage rate. The annual percentage rate is a measurement used to compare different types of loans, different types of credit. And what they do is they take all the variables into account, and then they express it as a single percent number. So you could have a 5% loan, which means you're going to have to pay 5% above what the amount that you borrowed. Or there's a 10% loan, and then you're going to have to pay 10% above what you borrowed. And so you can tell just by which number is bigger or smaller than the other, which one's a better deal. When you are paying interest, you want the lowest number you can get. And when you're earning interest, you want to get the highest number that you can get. So, different types of credit. We're going to start with just a credit card. The credit card is probably the most popular type of credit. When people talk about credit, that's what they generally think of, the small little plastic card. With a credit card, you apply one time and get accepted. You get a certain dollar amount that you can borrow, a top level, what's called the credit limit. And then you can repeatedly borrow that money over and over and over again as long as you pay it back. You can get credit cards from banks, credit unions, savings and loans, but you can also get it from stores, gas stations, and lots of other places. Of all the types of different credit we have here, credit cards generally have the highest interest rate. There's only one that has a higher interest rate, and we'll get to that later. And there's lots of other types of credit that have higher interest rates than credit cards, but those are generally not legal. So you have to pay more to use the convenience of a credit card. One of the biggest advantages of a credit card is that you can use it all over the place. Generally, when you have a national credit card like Visa, MasterCard, Discover, American Express, you could use that all over the place. You could use it online. You can use it in stores. You can use it at gas pumps. You could use it wherever they have those little symbols that says that it's accepted, which is pretty much everywhere. Credit cards are what's called an open-ended or revolving credit account. It's open-ended ended in such that once you apply and get accepted, it doesn't end until you decide to close the account. There is no expiration date on it. And it's also open-ended, meaning that you could borrow against whatever your credit limit is, pay that back, and then borrow again, and then pay it back and borrow it again. So let's say that I have a $500 credit limit, and I go out and charge something for $400. That means that my credit limit now is down to $100 because I've already used 400 of the 500. But as soon as I pay that bill and pay that $400 back, then my credit limit is back up to $500, and then I could make another charge of $400 if I wanted to. So as long as I keep on paying it back and refilling that credit limit, I can keep on going every day, multiple times a day, as long as I don't ever go over my credit limit. When we talk about paying the stuff back, the payments that we have to make on a credit card is generally based on how much you charge or how much your outstanding balance is. And they generally have a minimum payment and then a percentage of your balance, and then you have to pay whichever one is higher. And we'll talk about that specifically later on when we get to some other lessons. The next type of credit is called an installment loan. An installment loan is a direct payment of cash to you or the borrower, and then you agree to pay it back later at a fixed interest rate for a set period of time. Now, with an installment loan, your payments are generally set. You know when you sign that loan paper how much your monthly payment is going to be and how long you're going to be paying it. You can get an installment loan from banks and credit unions and other financial institutions, but you can also get them from auto dealers or other places like the Nebraska Furniture Mart and places like that that deal with high dollar items that people might not be able to pay for with cash when they walk out the door. Installment loans are generally reserved for larger purchases like cars, appliances, things of that nature, because every time you do an installment loan, there's paperwork that you have to fill out, and there's explanations that have to be done according to law. And so it's a relatively time-consuming process. So you're not going to use an installment loan to go get your groceries at no frills because it's just not worth the grocer's time to fill out the paperwork. And it's not worth your time when you get to the cash register and then you've got your ice cream sitting there melting while you're filling out paperwork. So it's generally just for larger purchases and infrequent purchases as well. The length of the loan, which is called a term, can vary depending on the type of the loan it is and how much it's for. You can have a loan that's a few months to pay. I've seen some loans that have been 90 days, and you have to have it all paid off in 90 days. And then some of them, many years. Most car loans are 5, 6, even 7 years to pay. So the length that you have to pay back can vary greatly. And normally, like I said, it's a fixed monthly payment. There are certain types of installment loans where it'll be a monthly payment for so long, and then it'll bump up or boost up. Or if you get a late payment, then there'll be an added penalty for the rest of the month and stuff like that. But generally, if you make your payments on time, it's going to stay the same thing throughout the whole loan. Now, comparing credit cards and installment loans, you generally pay lower interest because you're paying higher interest for that convenience factor on a credit card. The next type of credit is called a student loan. Student loan is a loan, an installment type of loan that is given to students to help pay for their educational expenses. Generally, it is for after high school or post-secondary expenses, but which means college or trade school, something along those lines. And it says they're tax deferred, meaning that it's income, you're having that come in for that loan, but you don't have to pay any taxes on it or anything. And it's also deferred in another way as well, we'll talk about here in a little bit. You can get a student loan from banks, credit unions, and the federal government. Although recently the federal government has gotten out of the loan business, now they just guarantee the loans to the banks and other financial institutions. So you don't actually apply to the federal government anymore. You apply to you fill out your FAFSA form, which is a form for financial aid, and then the banks, local banks, and even national banks look you over and decide to loan you the money. So the money's actually coming from a bank, but the federal government is guaranteeing that loan so that if you default, then the government will pay that bank, and then the government will come after you by taking your tax returns and things like that. A student loan could be used for any expenses that you have that you incur while you're going to school. So generally speaking, people realize it's for tuition, books, room and board that you'd have in a dorm room and stuff, but it could be for other living expenses as well. If you live off campus and you have to drive in to the campus to take your classes, then you can use your student loan to put gas and oil in your car or to pay for public transportation, a bus pass, and things like that. It could also be used for other things like a laptop computer to take your classes and things like that. So they're not very strict on what kind of living expenses you have. Now, it does have to be legal things, and it does have to go toward your school living expenses. So if you take your student loan and go out to the casino, then they'll probably look down on that and make you pay it back sooner. Depending on your income level, some loans allow you to defer the loan repayment until after you graduate. And so that means that it's called payment deferred. And so if you get a payment deferred student loan, then you may get a loan right after you graduate from high school, and then no interest will accrue, and you won't have to make any payments until after you graduate college or after you drop out or become less than a half-time student. So if you borrow $5,000 on a student loan as a freshman, it's still going to be $5,000 4 years later when you are a senior. Because nothing is going to accumulate on that loan as long as you're still a student that is taking at least half-time credits. Generally speaking, student loans have the lowest interest rate of all the stuff that we're going to talk about here because it's backed by the government. There's not a whole lot of risk there. The next type of credit is also an installment loan. It's a special type of installment loan called a mortgage. A mortgage is just an installment loan used to buy a home or some land that you plan on building a home on, or any other real property. The real property is defined as land and anything attached to it. So it could be a commercial property, a convenience store or a drive-in theater or something like that, or it could just be a wooded piece of land, or it could be a plot of land in the middle of town that already has a house and a garage on it. If you're getting a loan to buy any of those type of things, it's going to be called a mortgage. You get mortgages from banks, credit unions, savings and loan. Those are all financial institutions. It used to be that you couldn't get mortgages from all of those, but the deregulation of the banking businesses and things during the Reagan eras in the 80s made it so that different types of financial institutions could all get or all offer mortgages. It's used specifically for that real property. Most of the time, that's for somebody to buy a home, but it doesn't have to be a house. It could be a condominium. It could be a townhome. It could be a duplex. But generally speaking, it's for a place to live, whether you're living in it yourself or you're buying the property as an investment property and then renting it out to somebody. Mortgages, since we're talking about huge sums of money, they're generally repaid over a longer period of time. When I did some research for this, the shortest mortgage I could find that was just a straight mortgage, didn't have any weird things to it, was 15 years. And the average is 30 years. That's the most popular, is 30 years. But I have seen some that go up to 40 or 45 years, depending on the price of the home. But even with that, that longer term, you're still paying a lot of money. And we'll have a lesson later on where you can see exactly how much you're going to be paying when you get into long-term loans like 30, 45 years. Most mortgages have fixed payments over the entire loan, although there is one type of mortgage called an ARM, ARM for adjustable rate mortgage, that does have a bump in it after you pay so long. But most straight mortgages, it'll be at a certain percentage rate, could be 2%, 3%, up to 7, 8%. And then you'll have the same payment from month one to month, whatever it is. If it's a 30-year loan, it'd be 360 or the 360th payment. So it'll be the same all the way over if you don't have an adjustable rate mortgage. Since you're paying a lot of money on a mortgage, the interest rates on mortgages are generally smaller or lower than other installment loans, like a car loan or a personal loan, and stuff like that. And that's because when you're paying over, a 15 to 30-year period, you're going to be paying a whole lot of money in interest. And so they don't have to charge a high interest rate because they're going to get quite a bit of money out of you anyway. The next type of credit is called service credit, and service credit is when you receive a service and you pay for it later. Most utilities fall into the service credit. So if I sign up for electricity from the power company, I'm getting to use that power for the billing period for the month, and then at the end of the month, they send me a bill. But during the month, while I'm using all of the service there, when I'm using the electricity, that's actually credit because I'm not paying for it when I use it or when I receive it. Medical bills are that way. You go to the doctor and get billed later after the insurance gets done with it. Cell phone bills or regular phone bills, lots of different things are that way. There are some other businesses that work that way. It used to be if you'd go to somewhere like a mechanic or get somebody to come in, a plumber, that they would do the service, whatever, and then they would send you a bill through the mail. Now, there's a lot of people now that with the advent of electronic processing and payment systems and stuff, they'll carry a smartphone with them and do the credit card swipe right there and then. So there are fewer businesses now that are doing service credit because it's so easy to do credit cards. But there still are some businesses that still use service credit. Like I said, it's offered by utility companies and other service type businesses. You use it for whatever the period of time is. They track your usage, and then you get billed for it at the end of the time period. Service credit is generally interest-free credit. There is no interest if you pay your bill on time. And then if you don't pay your bill on time, then there's a late fee, which is extra money that you have to pay on top of that, which essentially is a type of interest because you're paying more than you should have or more than what the actual value is worth. So service credit, if you pay your bills when you get the statement, then it's interest-free credit. The next type of credit is called store account. A store account is an account with a specific store. This store credit or store accounts were a big thing back before we had a whole lot of big franchise type stores, like Walmart's all over the place, or Sam's Club or Menards or Best Buy and things like that, where most of the places were sole proprietorships, mom and pop type stores, and you just go into the store and put it on my bill, put it on my tab, and then they'd send you a bill at the end of the month. The no frills on the square here in Glenwood used to be that way. When I first moved here from Iowa City, I would be able to go down to, when it was Kyman's, I'd be able to go down and talk with Harold or Jerry Kyman and get something. If I didn't have the cash on me, I could just say, put it on my tab. And then at the end of the month, I'd come back and say, okay, how much is on my tab? And they'd tell me and I'd settle up. So I'd get credit. I wouldn't have to pay right away because they trusted me to come in at the end of the month and pay it. Most stores don't do that anymore with the rise of credit cards because of the risk involved. And a lot of the stores don't know you as well as when they were smaller single proprietor shops, local shops, and stuff like that. So they're not willing to take the risk. They'll have the credit card companies take the risk. If you can find a store account, generally you're going to find that at smaller places like gas stations, stores, things like that. You're not going to get them from the big box stores. Unlike a credit card, you have to use it at that place of business. And if the store account does charge interest, some of them don't, but if they do, they generally are higher than the national credit cards uh, because they're taking a larger risk on you. So if they do it, they're going to charge you more interest in order to cover that risk. The next one is a charge card. A charge card looks exactly like a credit card. If I held up two cards, you probably wouldn't be able to tell the difference, which one was a charge card and which one's a credit card, because they work the same. You take your plastic card to whatever store, you make your purchase, you swipe your card or stick it in the card reader, and then you get a receipt back, and then you do that and you get a bill at the end of the month or a statement at the end of the month. And that's all equivalent. Same thing with a credit card and a charge card. The big difference is that with a charge card, it says there the balance must be paid in full each month. So you can't just pay a little bit off your what you owe and then have it carry over to the next month. If I have a charge card and I buy $10,000 worth of stuff in a month, then I have to pay $10,000 at the end of the month. I have to have a zero balance at the end of every month. With a revolving credit or a credit card account, I could pay a minimum amount and still be in good standing and still use the credit card. And they're just going to charge me interest or a finance charge because I didn't pay off the balance. But with a charge card, the agreement says it has to be paid off at the end of each month. There aren't very many charge cards out there anymore. I've seen a few of them. The only ones I could find right now are American Express and Diners Club. And by the way, Diners Club was the very first charge account ever. That was for restaurants and things. But if you have an American Express charge card, you have no credit limit. You have no interest rate um, because you're expected to pay it all off. Same thing with Diners Club. You go out to a restaurant, you use your Diners Club card. When the bill comes, the statement comes at the end of the month, you have to pay it all off. There is no carry forward to the next month. So no credit limit, no interest fees, um, or anything because you have to pay it off at the end of the month. Now, how do they get their money? They get their money because most charge cards have a huge fee just to carry the card. It's called an annual fee. A lot of cards have $100 or more just to have the privilege of being able to carry that card around and say, I must be an important person because I have this charge card. That's how the companies are making their money. And the next one is called a line of credit. A line of credit is a pre-approved amount, kind of like a credit card, that you can use to borrow against, pay back, and borrow again as needed. Once again, kind of like a credit account or credit card account. The difference between a credit card account and a line of credit is that lines of credit are generally set up at a bank and they're or other lender, and they're used for things like home remodeling or construction projects and things like that. Where we don't know exactly how much we're going to need. So we go and talk to the loan officer and say, well, this is what I'm planning to do. I think I'm going to need about this amount of money. They approve that amount, and then uh, they will put that into an account, that amount that you're approved to in an account at their bank, and you don't have to pay any interest on it or anything until you take it out of that account. And as soon as you take it out of that account by writing a check or something like that off of the account, then that's the same thing as getting a loan, and then you have to start paying it back. So a line of credit is good when you don't know how much you're going to have to pay for things like you're going to remodel your bathroom. You don't know, what you're going to have to do until you demo the bathroom and find out what kind of damage is there. And so you get a line of credit so that if some unexpected expenses come up, then you have the money to cover that and get it repaired. So we set the maximum amount that can be borrowed, and then we only have to pay interest on the stuff that we actually use. If I get a line of credit and then do my own work, and I cover all of the costs of materials and stuff on my own and don't need to dip into that account, then I don't have any interest that I have to pay. I can go back to the bank and say, hey, I got through this project. I didn't need any of your money. Thanks for doing it for me. And then I don't have to pay any extra. But if I do need to because of rotting in the floor joist or something like that, then I have that money there so I can get things done without having a half-done project that has to wait until I can save up for the money. Now you might be wondering, well, why would I have a line of credit when I could just use a credit card? A line of credit generally has a lot lower interest rate than a credit card will be, because it's for a specific thing or a specific project and things, so there's not as much risk involved in that as with just a credit card where you can have impulse purchases and other things like that. So if you are going to do a project, you're better off getting a line of credit with the bank and paying a lower interest rate than just putting it on your credit card and having to pay a lot more in interest. Businesses generally set up lines of credit a lot because they might have times where the business is slow and they're not having a lot of money coming in, but they still have to pay for their utilities and for their employee salaries and for insurance and all sorts of other things. And so they use a line of credit to kind of even out those slower times when they're not having the money come in as fast. And then when business does pick up, say on the weekends or maybe in the summertime, then they can pay back on that line of credit, and then it kind of evens things out. So businesses use lines of credit a lot. Okay, so that's it for the types of credit. So the next thing that you need to do is you need to complete the activity uses of credit that is posted right below this video here. If you have already completed the uses of credit in the earlier e-learning stuff that we did, then it should be marked as done already. Otherwise, you have to do that, and once you get it completed, then you can do the exit slip quiz that's in Schoology right below the uses of credit. All of these things are due by Monday, April 20th. And on Monday, April 20th, you'll get your next lesson activity and assessment. So if you have any questions, make sure you make it to the Google Meet and ask your question, or you can always email. Thanks for watching.